If you come to market with a good story, a good business, and the right valuation, you can actually get the deal done.
Do you still feel like there are opportunities within the foundation model space, or have the OpenAIs of the world already sort of run away with that?
Fundraising has been weak, exits have been weak, but there's actually been a lot of activity in the early stage VC level.
If we go into 2026 and it feels like things are still stuck on the IPO front, where does the liquidity come from?
The market's going to have to consolidate or thin out, and you're going to probably have some losers.
Welcome to PitchBook Outlooks. In this series, our analysts unpack current trends and investigate future opportunities in the private capital markets, providing investors and deal makers with critical insights they need to beat the market. I'm James Thorne, head of PitchBook News. With me today is Paul Condra, global head of private markets research. Paul leads a large global analyst team that produces multiple outlook reports spanning private equity, venture capital, and of course, AI. Paul, thanks for coming.
Thanks for having me. It is indeed Outlook season again, and our team has produced a lot of content to help clients understand the direction of capital markets.
The direction we're pointed today seems to be more AI. Data center and model training is approaching $1 trillion annually. VC, of course, is heavily concentrated in AI. About 64% of venture dollars, or 160 billion, went to AI in the first 3 quarters of the year. I think what that kind of obscures is how concentrated those dollars are among just a handful of companies. In Q3, about 4 companies took half of the total. In some ways, this feels unprecedented. In other ways, it's reminiscent of past tech cycles. Where do you fall on that?
Yeah, for sure. I mean, there's definitely a lot of concentration at the top in terms of some big AI leaders that are getting a lot of the attention. But there's also a lot happening more downstream in this market. And our team has actually done a lot of good work in laying out what AI opportunities look across the landscape, at the horizontal kind of model layer to the vertical application layer, healthcare, enterprise, deep tech, consumer tech. There's actually a lot going on there, and they've produced a pretty comprehensive view of how these opportunities are evolving. But I'd also point out a couple areas where I think this cycle is a little different from what we've seen in the past. The first is building on top of these emerging AI models is relatively cheap. There's a lot of money going into building the models themselves, but it's relatively easy for startups to then start building applications and use cases upon the top of them. So most of the investing certainly in the foundation models, but we're also seeing a lot of traction in things like autonomy, perception software, data management. And then on the vertical side, you've got like coding agents, customer service, a lot of things happening in healthcare and drug discovery, to name a few.
Drug discovery, that's an interesting one. We've kind of heard about AI and drug discovery, but it feels like it's turned a corner lately.
The drug discovery side of it's actually really exciting. AI has the potential to almost double clinical trial success rates in some of the early stage trials, and that's going to lead to a lot more rapid drug development at a lot more of a lower cost. And I think that's going to attract a lot more capital investment into that section of the ecosystem. Last year, AI healthcare startups raised over $10 billion.
Obviously, a lot of money accruing to a very small number of companies. The big debate today seems to be, is AI in a bubble? I think, like you said, one of the differences today is that unlike the dot-com boom, say, these companies have real revenue. But where are you seeing examples of frothiness in the market?
One of the things that our team pointed out is in the space of AI scribes. So maybe in the healthcare sector, right? So there's a lot of SaaS integrating AI, but a lot of it looks similar and will start to feel a little bit more commodity-like, even though you're adding an AI layer so the technology is more advanced. But an AI scribe provides a very similar type of function across different use cases. So undoubtedly, some of the big healthcare systems are going to be integrating AI scribes into their workflows. It's going to become a more common product you're going to see across the landscape. But there's probably more in the market now than what you need, right? The big healthcare providers are not going to use dozens of vendors. They're going to use a couple. And what that means is the market's going to have to consolidate or thin out, and you're going to probably have some losers. So that might be a space where somewhat easy to spin up the product, but somewhat harder to get enough market share to have a sustainable business.
Yeah, in some ways, on the application side, the problem is things might be a little bit too easy. On the foundation model side, obviously it takes a huge amount of capital, resources, and talent to just get up off the ground. Do you still feel like there are opportunities within the foundation model space, or have the OpenAIs of the world already sort of run away with that?
Yeah, I mean, I think as our analysts had pointed out, like that's really where the arms race is. How much money can we crank into these models to have the biggest, fastest, most powerful model out there? And that's where the biggest prize is too, because if you own the model, then you essentially own all the downstream software and aspects of the ecosystem, and all that value accrues right back up to the model owner, right? Which is kind of the foundation of that ecosystem. So even though it feels like there's a lot of capital going into that space, I would expect that pace to continue just because the benefits of being the core foundation model are so large and so massive. And even though you have these providers that seem to be winners like OpenAI or Anthropic or XAI, they're getting a lot of the investment, they're getting a lot of growth, they're getting a lot of attention. You still read about new entrants into the space, or maybe not new entrants, but just competitors that have been there, that they beat some sort of performance metric that was unexpected. A company like Runway that just showed up recently with an image generating capability that seems to exceed what you see from other providers. And then you've got big incumbents like Google that have always been in AI. They just haven't tried to commercialize it the same way some of the modern foundation models are doing, but now they are, and they're starting to make significant headway into the market.
Yeah, Google's latest release really, caused a bit of a panic, I think, in the market, and showed that this isn't, a race that's already won. One thing that we've been looking out for is, the emergence of AI agents. We've heard so much about them. We haven't seen them necessarily in the real world that much yet. What is preventing today's LLMs, which seem on the surface like they're capable of anything, from going out and doing the work that knowledge workers do today?
Yeah, I mean, LLMs provide that foundation layer, but in order to make the technology accessible to your everyday employee within an enterprise, you need that application agentic layer that can leverage the LLM to do the work that you want it to do. An LLM is very task specific. It can kind of do one thing very well, but it can't necessarily do everything on the front end and on the back end that you want to complete every day when you go to work. And so the opportunity with agents is, can we string together these pieces so that your employee, your everyday worker, can then replace, not necessarily replace, but augment their entire workflow using AI. And an LLM model alone is not really good at that. So the agentic opportunity is stringing together those different processes that need to get done into one continuous workflow, and building a product that's much more useful at an enterprise level.
Yeah. It's kind of an interesting corollary in the real world with robots. AI robotics seems like it has the potential to maybe change the way that we think about the role of machines in settings like warehouses and other spaces. How is that evolving?
Yeah, I mean, there's a lot happening with robotics, and our team does a lot to outline all the different areas where we think robotics have a big role to play. And for now, I think of it as very task specific, where the stakes aren't really too high and you have single operations that a robot can probably do better than a human can. So give you some examples, right? In agriculture, AI can really help distinguish between weeds and crops and spraying herbicide where it's needed. Warehouses, you very controlled environments that are already highly automated in a lot of ways. You can have robots that actually work directly with humans in these situations to augment their ability to get their work done. You can also have robots that can move pallets around, or they can drive trucks around in very controlled environments. And then I think you get into things that are a bit more next horizon robotics, like surgical robots. Very promising, but also very highly regulated. This is where the stakes get higher. You don't want your surgical robot to make a mistake. And so even though we know the robots can probably do the work today, it's going to be a little longer before we see them in widespread practical use. Autonomous vehicles. You go to San Francisco, you see Waymos everywhere, and they're rolling out Waymos in more cities every day. So it's becoming more common, but it's still not massified across every city in the US. So I think autonomous vehicles is another area where we're going to see a lot more steady, gradual growth. And then I think your question kind of gets into humanoid robots, right? And that's where people talk about, are the robots going to take over? And I still think that's a long ways off. Like your Roomba is going to get a lot smarter, but a robot that can walk around your house, do everyday tasks, I think that's a ways off. There's simple tasks that seem like they should be easy, like picking a glass up off a table, are actually quite complex for robots. And I think we're still several years away before we have robots in our house where we're actually, facing that question of what's the existential threat to me as a human if I have these robots doing things in my house.
So we won't be toasting robots on New Year's Eve anytime soon.
There may be a robot that can just toast drinks. I wouldn't, I would bet on that, but one that can pour the drinks and make the cocktails, maybe not yet.
It seems like that's one of the ideas that could have gained traction in VC a couple years ago. That is not the world that we live in today. Although VC activity is picking back up, we've seen obviously that fundraising has been really sluggish. So what do you see looking ahead to next year?
Yeah, it's a little bit counterintuitive because fundraising has been weak, exits have been weak, but there's actually been a lot of activity in the early stage VC level. And I think that reflects two things. One, you had a lot of funds that went into this downturn with a lot of dry powder. So they're still able to put capital to work for good opportunities. And second, you've got this AI revolution that's just picked up so much steam over the past 2 years that funds are finding ways to get capital, to get exposure to it. It's something that you don't want to fall behind on, you don't want to miss. So even though we don't have the traditional exits, distributions, fundraising cycle happening at the pace that we're used to, there still seems to be a way for a lot of active early stage VC investment.
So we were able to keep that early stage engine running despite everything that was going on in the market.
Yeah, surprisingly so. I mean, there were some lean years after COVID, but first financings over the last year or so are on pace to be the strongest since 2021, and that really reflects some resiliency in the ecosystem. If you think about companies like incubators, like Y Combinator, they've still been very active in cranking out new startups.
What about the later stage market? I mean, obviously, we've seen some massive deals this year, but for a very focused group of companies, it seems like that part of the market overall has been pretty slow.
Yeah, in terms of volume perspective, a little bit slower, but actually very active from a dollars perspective because we've seen some really massive late stage deals, especially in the AI space, and a lot of type of anchor properties that are able to raise a lot of money. So it's really about quality over quantity, and it's really about AI driving those opportunities. In the back half of this year, we've seen a lot more focus on venture growth activity. So really trying to find ways to accelerate the growth of some startups that maybe would be going public in a different kind of environment, but in this environment, they're happy to raise capital through private channels and continue to grow as a startup. And you also have a lot of startups that are actually finding product market fit. We're not just looking at speculative businesses at this point, but businesses that have real revenue, and in many cases even starting to be profitable, and that's still able to attract a lot of money.
It's able to attract money. It's also able maybe to convince the public markets that they should invest in you. Speaking of which, what is your outlook for the IPO market looking forward?
We're looking for some improvement. The IPO market got a little better in 2025 and probably gets a little better in 2026. There was actually a lot of very strong momentum in the earlier part of 2025. You had some companies that went public and saw considerable one-day pops. And I think that's very important to the psychology of the exit market. When you see IPOs that work really well within the first few days of the launch, that just brings more people to market. And that momentum seemed to be picking up steam. Of course, you had the government shutdown in the latter part of the year, and that really closed off the IPO spigot, and we haven't really seen that kind of snap back, right? So 2025 was first in a lot of ways in terms of new volatility related to tariffs, geopolitical economic uncertainty, the government shutdown. So there was definitely a lot of eagerness to get the IPO market open again, but then there were a lot of headwinds that just kind of slowed down a lot of that activity. So as we look forward to 2026, the hope is that some of that is behind us, at least the initial volatility, and then the market can get back to bringing companies to market. We've had several years of correcting valuations, and I think what 2025 proved is that if you come to market with a good story, a good business, and the right valuation, you can actually get the deal done. Things like AI, crypto, defense tech, there's a lot of demand for those businesses, and those businesses are actually generating revenue. So I'm optimistic 2025, or 2026 rather, can keep some of that momentum that we saw in 2025.
So it sounds like the critical component here is prices, getting the valuation for the company right, having a good story to tell.
Exactly. I mean, you need to come to market with the right price so that buyers are interested to take a share of the thing that you're trying to sell, right? Of the 15 unicorns that went public last year, 13 went public at valuations that were lower than their previous private market peak, right? Investors loathe having to sell something for less than what they paid for it, But the reality is that's the only way you're going to get deals done in this environment. So despite all that uncertainty in 2025, you had some big high profile IPOs that initially did really well, and that bodes well for 2026, as long as you're kind of following that formula.
Yeah, it was a weird thing, but I think, a story of 2025, this idea of taking a haircut on your IPO, something that companies several years ago never would have dreamed of. Mm-hmm. If we go into 2026 and it feels like things are still stuck on the IPO front, where does the liquidity come from?
Yeah, well, what we saw in 2025 was that the secondary market really bloomed. And I think this year's going to be remembered as the year that secondaries went mainstream, both as a route to liquidity for your LPs, but also as a legitimate investment strategy. And then there's also a lot of more momentum to create more infrastructure around the secondary business to make it a market that functions more smoothly. And you had a lot of acquisitions from the likes of Morgan Stanley, Goldman Sachs. They're all trying to get active in this space, and they probably wouldn't be doing so if they didn't see a future in it. So still, I don't think this ever really replaces the traditional IPO, but it does become a important secondary market and an alternative route to liquidity for your LPs.
Yeah. It grew hugely this year. How big is it now?
Yeah, so our team did a lot of work on this. And when you add together GP-led secondaries and direct secondaries, they're sizing the market about $95 billion, which is actually similar to what the IPO exit value was in 2025. So
unbelievable.
A lot of improvement. I think that when IPOs pick up again, it's probably going to dwarf the secondary market. And you may find that some fund managers opt for IPOs over secondaries. But still, this is going to be an emerging and evolving piece of the market that's probably not going away.
Yeah. Let's switch gears to private equity. Can you give us a sense for where the market is right now?
Yeah, I mean, overall, I think similar to what we're seeing in other asset classes, deal activity has been slowly on the upswing, right? Actually pretty robust toward the end of the year, anchored by some very large take private deals. Now, LBOs are still down from where they were. You've still got this kind of high interest rate environment that makes it complicated, but the LBOs we are seeing are massive and historically large, and that's really important for the industry. We've also seen a lot more activity in terms of growth and add-on deals, and that's adding a lot more volume to the PE deal environment. One of the things that our team is focused on is exit activity, which is probably one of the most important components of the PE life cycle. You need to exit assets out of your portfolio so you can distribute funds back to your LPs, and that can be then recycled into new funds. The average age of assets in PE portfolios continues to get longer, is trending above historical averages. So that's putting a lot more pressure on PMs to engineer liquidity however they can. And that speaks to continuation funds, which is something else I'll talk about in a second. But in order to get that exit window to open, you really need to see more stability across the things that we've kind of the recurring theme of this conversation, right? The IPO market has to open up. You've got to get some clarity on where interest rates are going to go. And you need just overall economic stability with things like geopolitics and tariffs.
Yeah. Similar to the market for VC direct secondaries, continuation funds have been one of those things that grew very quickly out of necessity, a huge amount of just a big need to sell assets. Looking ahead to 2026, do you think continuation funds still have room to grow?
Yeah, I mean, the way that our team's characterizing it now is that you're still going to have an active continuation fund market, but maybe it steps back a little bit from the frenzied environment you had in 2025, where there was so much pressure to generate liquidity. You had higher interest rates. The exit market was so closed up. If you assume that all of those trends reversed in 2026, so the exit environment gets a little more favorable, combine that with the fact that a lot of the continuation activity you really needed to do was done in 2025, you probably have a little bit less continuation activity in 2026, but by no means does it go away. It still remains an important part of the market.
Mm-hmm. So this year your team did something a little different. You actually went out and surveyed the market. What did they say?
Yeah, so we ran for the first time a survey of GPs, LPs, bankers in the private equity space, just to get a good sentiment gut check on how they're thinking about the markets heading into 2026. And so some of the main findings were that when it comes to sentiment, this group was slightly more bullish, slightly more risk on heading into 2026. Again, I think consistent with how we're feeling about the other spaces as well, that kind of cautious optimism, things feel a little better, but no one's really to just go full bore into these markets at this point yet. The other thing they asked about was exits. Exits just remain top of mind. It's a main focus point for fund managers. And how are they going to manage distributions back to LPs? And I think that there's a lot more institutionalization of exit processes happening within these funds. So it's going to evolve, and we're going to see that in the form of continuation as well. But the hope is that the IPO market starts to open a little bit and you get a little more of that traditional exit activity. The last thing we asked them about was, where do you feel the most bullish in terms of sectors of the economy? And the answers that came back were AI infrastructure, and energy, right? So we know that there's a lot of build out for data centers, AI infrastructure, and the like. That requires a lot of energy to power these data centers. And then you also have really a pretty substantial global energy transition taking place currently. It feels like in the US, maybe there's been a bit of a step back from that, but in the rest of the world, the shift to solar, the shift to wind, that's actually a very big deal, and there's a lot of investment happening there. And importantly, these aspects of the economy, these areas of the economy are pretty stable cash generating. They're pretty resilient businesses. They're already generating revenue and cash flows, and they're margin positive. And those are very attractive features to PE investors.
Mm-hmm. We've covered a lot of ground.
Sure.
And there's a lot going on in these markets, a lot that could happen. What's your North Star for next year? What are you watching most closely?
Yeah, so there's two things that I'm really paying attention to, right? So the first is AI, and specifically, is the sector overheated, right? That's the question everyone's on the top of everyone's mind, really, right? Are we going to see valuations in terms of growth and profitability to sustain the activity you saw in 2025? Or is there a pullback on the horizon? So I think that's one of the things that I'm really paying a lot of close attention to, just the state of AI going into 2026. The second one is really economic and political stability. So 2025 ushered in this new era of protectionism, tariffs, and just lots of geopolitics that are on a different level than what we've seen before. And this caused a lot of volatility, things like the longest government shutdown in history. So the question is, to what extent are these kinds of things behind us, and how do they play out in 2026? And I think there's still a lot of question marks. There's still a lot of uncertainty, but the hope is that the initial kind of shock of these changes, the initial volatility is behind us, and we just get more stability going into 2026. So those are really the two things that are top of mind for me, and I think top of mind for a lot of investors as well.
We've only scratched the surface here, but I think that's where we'll end it.
Thanks for the conversation. There's a lot more information in the work the team has done across a range of private market segments, from an asset class perspective to technologies and different industries. And there's a lot of information in there. And I would stress checking out the actual reports. You're going to get a lot more information from just this interview.
If you want to read more, you can go to pitchbook.com or check out the link in the description.